you hear that, Holly?
I did.
Oh, wow.
I'm so proud of you.
Oh, thank you. Yeah, pressing a button, that's a big step. Cassie, you got on. We were
I
super
can't hear
nervous.
you talking to me. Sorry.
No, but it just kept spinning and it said it was connecting to audio. And
Oh, I was trying to put some lunch together.
there you go. Luke double shot. Luke and Chelsea. I love that.
So you're in California?
Most of the time.
How was
But
your
it's-
snowstorm, the blizzard that you had?
It's very rainy.
Hmm.
Not. Okay, how do I do this? I share. Here we go. How about that? Everybody see my screen?
Yes.
Perfect. The only thing is, Holly, where I get goofed up is there we go. So it'll keep telling me as people come in here and I'll just keep an eye on that. Holly, can you see that?
I cannot see it as people are being admitted,
Gotcha. Now I know what it feels like to be Liz.
right?
Yeah, absolutely.
It
And
is
then people,
hard. It's really hard, I feel like, when you're hosting, because it's like it seems like it disappears and then all of a sudden you got
Hey,
five.
Colin, if you can make me the host. And then I can admit people as they come in. Since your screen's already up, if you'd like. Or not, it's fine.
cool. And you can still see we're good.
Well, now your screen's gone.
I'm reclaiming the host. Yeah. All right. I mean, Cassie, I feel you. And the thing is that, I mean, you're a woman. We all know men can't multitask. So like, it's going to be a little challenging here. Okay. Well, welcome everybody. Especially for those of you who are new here. Welcome to Pemberton Homes Team. Welcome to its affiliated broker, Flex Mortgage. Can everybody see the slideshow presentation right now? It's usually not this rocky, by the way, Jennifer. So
it looks great.
You know, we rolled out this new Zoom, not unlike your new Mac. So we're all playing with new toys here, so to speak. This is a weekly Wednesday installment that we do that tries to give you content on social media. It works to give you the best knowledge of what changes are coming to the lending industry. And Matt and I always talk about, Parker as well, you don't need to know everything, but if you can pick up a knowledge nugget in these presentations that you can use while prospecting, or again, using on social or whatever it might be, that is the end goal here with providing you a little bit more knowledge about what's happening. If you're on this training, you're in a good spot because we're going to talk about some stuff that I don't want to say is radical, but is changing our industry substantially. And I think it's going to ripple through the housing market in 2023 and beyond. So this is a good one that you guys have found yourself on today. As always, if you have questions, feel free to jump in here, interrupt me. This is a fluid conversation between me and you guys. So, and then of course, our number one rule in lending, there's no such thing as a dumb question. So let's get started. Let's talk about changes that HUD made to FHA and VA. Let me back up a moment here. HUD is the Department of Housing and Urban Development. It is the government arm that sets housing standards for the administration. Okay, so when you talk about conventional loans, we're going to get into that territory a little bit later in this training. But when I say HUD, remember that HUD is in charge of FHA, VA, and USDA, because those are government insured loans. All right. So on February 22nd, the administration said it is going to cut mortgage insurance monthly on FHA loans from 0.85% to 0.55% for most new borrowers. This is a pretty substantial change. This is the first cut that has been made to the monthly PMI on FHA loans since 2015. The Obama administration cut in 2015 PMI from 1.35% to its current, for a couple more days, level of 0.85%. There's a lot of political back and forth when you talk about administrations coming in and who the Secretary of HUD is, and we don't need to get into that, but interestingly, this was actually slated to be cut in 2017. It was one of the last acts of the Obama administration, and the reversal of that cut was one of the first acts of the Trump administration. So this has been a political football for some time. It's important to note that FHA will charge you two different kinds of mortgage insurance. They'll charge you upfront 1.75% of the loan amount. 99% of the time that gets rolled into the new mortgage, right? But they also will charge you this monthly MIP. So the upfront portion is not changing. It's the monthly portion that is reduced. And then what's the why in this? This is to fund the program. HUD needs $2 billion in reserves and has about $11 billion. So it's time. When you have almost 6x your required reserve threshold, I don't think it's a bad idea to look at, all right, how can we make homeownership cheaper for especially first-time buyers. When you think about it, 80% of people that use FHA loans are first-time buyers. So this is something that's, if you work with a lot of first-time buyers, this is something that you're going to want to know in terms of, hey, by the way, did you know your monthly payment just got cheaper? Questions on this slide?
I have a question.
Jen, if
Is that retroactive or is that only from now on? So like if someone already has PMI, are their payments going to reduce or is it just from this point on?
it is only for new loans.
Okay.
Yes. And Brandon Oppelt asked that question. Brandon, are you on here? Maybe not. So the answer is it is not going to affect existing FHA loans.
Okay.
Interestingly, if you guys really want to talk about this, they have wanted to do this for a long time, but the rate environment has to be right. If you think about it, if you've got existing FHA loans and, you know, you have a 3.5% interest rate, rates in 2017, when the Trump administration reversed this, were around that 3.5%. What they wanted to avoid was a crush of FHA refinances at pretty much the same rate that just made the mortgage insurance slightly cheaper. So right now, you know, nobody's going to refinance a 3.5% FHA loan into a 5.5 FHA loan just to get the mortgage insurance break. So the interest rate has sort of helped push this forward. But long answer to your question, this only applies to new FHA loans. It will not affect PMI on existing FHA loans.
Okay, that makes sense. Thank you.
Good question. All right. Is it super easy to understand? Well, of course not. No, this is mortgage lending. This is the government, right? Why would it be simple to understand? So it's not just 85 to 55 basis points. We don't need to linger on this slide a whole lot, but for the sake of being precise, this is what this will look like for different LTVs. You'll see if you put 5% down on the FHA loan, you know, you can get a small break, right, where you go from 0.55 to 0.50%. But you know, I mean, you're talking about this baseline going from 0.85% to 0.55%. This might be something to keep in mind more for lenders. If it's like, hey, you're really close to 5%, you want to get an extra cheap mortgage insurance, yes, we can squeeze you into this sort of program. So there are derivatives of this cut, but the easiest one to understand is right here in this top line, 85 basis points to 55 basis points. All right, Colin, that's cool that you're talking about basis points. Let's talk real English here and what we're talking about in terms of what the monthly savings is. Hopefully you all got my email the day that this was released. This is a chart that we put together that reflects what the difference in monthly payment would be in increments of $50,000 for the loan amount, right? So if you look at this, what color would you call this?
Salmon.
Salmon?
Yeah.
All right. All right. So if you look at this salmon column, this is what the old mortgage insurance would look like for FHA at these loan amounts. This is what the new mortgage insurance would look like for FHA at these loan amounts, assuming minimum down payment of 3.5%, right? So Alexa is on this call. Alexa has been working really hard. She has a buyer that is moving here from Utah, and they are buying a $540,000 property, and they're using an FHA loan. And what we wanted to do is wait until this was rolled out, because that's a huge difference in monthly payment, right? $150 a month for a roughly $500,000 loan. If you still have access to this email, you can go to this bottom manual calculator and calculate exactly what the savings would be. So if somebody's looking, hey, you know, I'm right on the fence. I want to buy this house. I want to use an FHA loan. It's $320,000. How much cheaper is my monthly payment going to be? You can certainly calculate this, or we can do that for you. But this graphic right here would be valuable for social, for example, in terms of what the difference is and how much cheaper dollars to donuts someone's payment is going to be. Questions about this? Cool. All right. Now we're going to get into conventional changes. All right. So we talked about HUD, FHA, VA, USDA. Those are government insured loans. Conventional loans are through Fannie Mae and Freddie Mac, right? Which are also government sponsored entities. I remember I had a client that came to me about 3 years ago and said, I want a loan where the government is not involved. I said, that's great. It's called cash. You know, I mean, realistically, the government is so involved, conventional, privately insured, government loans, government insured. They're so involved in home lending that anytime they pull levers like this, it affects the entire housing market. So Fannie Mae and Freddie Mac are rolling out something called loan level price adjustments. And those are basically changes to the interest rate that you're going to get based on loan features. The big ones are credit score, loan to value, or how much down, occupancy, right? Are you going to own this, or is this going to be an investment property or vacation home? And effective now, your debt to income ratio. You may not have known this, but your debt to income ratio has never affected your interest rate, regardless of the type of loan, right? You think about it, you come in and you've got a 50% back end debt to income ratio, and you're using a conventional loan or an FHA loan or a VA loan, your interest rate's largely exactly the same as somebody that has a 20% debt to income ratio. Credit score and loan to value, and whether you're a first-time home buyer, have been the big movers. Now debt to income ratio is coming into play. This was rolled out on January 19th, and it's to take effect May 1, but a lot of lenders have already made this adjustment to their pricing sheets. So let's talk about what's changing in two different slides. This is like a heat map for those of you that are interested in investing. So you look at this top level here. This is loan to value. Okay, so 97% means you've got 3% down. 95%, 5% down, 5 to 10%, all the way down. Okay, and then on the left side, you can probably figure out this affects your credit score range. All right, so this is reflective of what is changing in terms of the government-sponsored entities, Fannie Mae and Freddie Mac, making changes to what kind of interest rate you get. If you look down here in the bottom part of the chart, there's a lot of green. So people that have credit scores that are 660 or 680 and below and are putting just 3 or 5% down are getting a break on their interest rate, right? In other words, they are incentivizing, Fannie Mae and Freddie Mac are, lower credit, lower down payment borrowers to get loans by cheapening the interest rate through softer loan level price adjustments. All right, that's fine. That is what it is. I think the issue here that I have, at least, and take my opinion for what it's worth, which is exactly what it cost you to get on this call today, nothing. The issue here is that, are they robbing Peter to pay Paul? Because if you look at this, look at the really red part of the chart. They are now punishing, for lack of a better verb, you for having 15 to 20% down and a credit score that is 720 to 759. Your rate's actually getting not 3/4 of a point more expensive in rate, but basically this is like 3/4 of a point when you talk about a discount point, buy down, things of this nature, right? You know, if you look at that as a reflection on a $300,000 loan amount, you would be charged $2,250 more than you were under the old rules. Okay. So the issue with this is not so much that it's making home ownership more affordable, which I think is a good thing. I think it's doing it at the price of homeowners that have put themselves in, home buyers that have put themselves in a better position to buy. You know, your 15 to 20% down or 10% down buyer that has decent credit.
I mean, Colin, don't they essentially just want those people to borrow more money because they're a better credit risk, right? So they don't make as much money if you take out a smaller loan amount. So no, why not encourage those people to take out a larger loan amount because they're going to make their payments?
Yeah, that's part of it. It's a great question, Nicole. You're getting into the why. And I think there are a lot of reasons why this is happening right now. Number one, there's a political element of this. There's no doubting that, right? I mean, there's how can we get more homeowners that have been punished for lack of credit and low down payment? How can we get them into home ownership? All right, that's a big goal of the administration. They'll tell you that, right? I don't want to talk about redistribution of wealth. I mean, we don't need to go down that political road, but that's an undeniable element of this. Okay. Number two, this is the biggest red flag that I have seen that's waving out there. It's saying rates are gonna go down, right? Because all of this applies. There are big changes to this this applies to rate term refinances too. So when I've talked about, hey, lenders are trying to get your money right now because they're not going to keep your loan for very long, right? Rates are at 6.75% today. They might be 5.75% at the end of this year. All right. If that happens, you're going to want to refinance. Well, when you refinance, right, this is a built-in mechanism that Fannie Mae and Freddie Mac are saying, well, we got to make our cut, right? It also sort of puts a wrench in this thought of date the rate, right? We talked about date the rate, marry the house, but if these loan level price adjustments are applying effective May 1 to refinances as well, right? It becomes a little bit more challenging to sell people on the idea that you can refinance a conventional loan down the road. They might have a little bit more equity, right? They might improve their credit with that mortgage trade line on their credit report, right? And so maybe they might fall in one of these categories where they might get hit a little bit on this loan level price adjustment, okay? And then the third thing that I'll say, that's the why of why this is happening, which is pretty deep in the weeds here, is that anybody have Credit Karma? Who has Credit Karma? Somebody say yes.
Yes, but I
my
don't think it's
card-
accurate.
Yeah, I think one of my
Perfect.
credit cards provides it.
Yes. Okay. Credit Karma, and that, Jelena, you answered beautifully. Yes, but I don't think it's accurate. Okay. Credit Karma is a great free tool. I use it. I think it's good. But it works off of a Vantage score, which is credit that goes to 1,000 points. Okay. The three credit bureaus, Equifax, Experian, and TransUnion, they go to 820, 840, or 850, right? So they're 150 points plus lower than the ceiling that Credit Karma uses with their Vantage score model. All right, that becomes problematic because people come to me or they come to Matt and they're like, hey, I've got 630 on Credit Karma. Yeah, you're probably at 585, right? Because it's working off that higher scale. It's not an accurate representation, to your point, Jelena. Why are
But
we
I
talking
actually
about
think
this?
it's the opposite for me.
What?
When I've had my real credit report pulled, my score is in the 800s and Credit Karma will only ever keep me somewhere between like 740 and 760.
That'll
So no
happen.
matter what, it's not accurate.
Okay. Yeah. The Vantage score model, that it's pretty rare. I would say 8 out of 10 times you're going to get it going. That's a nice surprise, by the way. I'd much rather have it do that to you than what it typically does to people, which is surprise, you're at 640. The point of this is that Vantage score is coming into the lending space. All right. And this long monopoly that FICO has had on you're only going to use Equifax, Experian, and TransUnion to determine credit scores for mortgages, that's going away. All right. Credit report costs have tripled in the past couple of years because FICO's like, oh man, we got to get our money because people are going to start using Vantage score, which is totally screwed up. And I could go on and on about that whole, like it's crazy that's kind of the credit model, right? But the point is that if you move to a Vantage score model, and if you have naturally inflated credit scores, okay, then you need a chart that we're looking at that reflects that updated credit score model. In other words, if everybody's credit score is what they saw on Credit Karma, well, then this chart starts to make a little bit more sense, right? So there's a political element of this. There's a servicing runoff element of this in terms of refinancing down the road. And then there's a credit element of this. Questions on any of that? It is kind of
Colin, it's
crazy.
Jen. I got one.
Hey, Jen.
Hi, I'm driving. So here's my issue is now I'm hearing, date the rate, marry, blah, blah, blah. That was great. That was great. Publicize it, advertise it. So we all did. And now I'm hearing, just kidding. I struggle sometimes putting this information out. So I typically don't. I kind of leave it to you guys to put that information out and maybe I'll share it or things like that. But it's broadcasted to broadcast it, right? And now suddenly everything's changing. So all that advice, and maybe it's a question for another day, but does that put us as agents into any ramifications that all that advice we gave. And now what happens if people can't refinance? I know that there can always be an issue, but is there any or is there a disclaimer?
Is anybody else losing?
Yeah.
Yeah,
You got-
Jen,
Jen, hold
we're
on.
losing you a little bit, which is okay. I got the gist of your question. We're going to touch about refinance capability down the road here in a moment.
know,
As part
That
of this
one valid, but somebody did utilize it. Now what?
Yeah, I mean, I think that, I mean, you look at this, I mean, these are hard facts in terms of numbers. I mean, this is something that you absolutely can share. I mean, I think that it's so interesting in that everything is financing driven right now, right? And so, you know, I think that most of you know, you stay away from rates unless you're discussing them as a range or citing a source, because, you know, you have to have an NMLS number, right, to talk about some of these really deep mortgage related issues. I mean, I don't think that this is going to do anything for anybody posting this on social media and, you know, trying to explain these hieroglyphics. But I mean, I think in terms of the risk factor of it, I think a lot of that can be left to the lender, right? I mean, the lender's job is to qualify the client, have conversations about what payment you're comfortable with. You know, that is all something that is a burden that you don't have to wear as the real estate agent. Nicole, I mean, I'm just curious your opinion. You've been doing this a long time. You agree? I mean, what would your thought on that be?
As far as realtors taking on the burden of,
Yeah, you hear what Jen's
market
saying, which is
shift?
like, hey, you know, do we advertise this? Do we not? You know, I mean, like, do we talk about this?
yeah, I mean, I don't think there's like a whole lot of harm in talking about it. I mean, things can change, right? Like, that's the reality of our economy and the reality of real estate in general. Like, there's never a guarantee, right? So I think it depends a lot upon like how you present it. And I don't, to say that people aren't going to be able to refinance, I think is a really rigid statement as well, right? Like, they might not be able to refinance this year, but if it makes sense with rates to refinance next year, like, that's still a possibility. You're not giving them like, oh, in 6 months, you'll be able to refinance and get a lower interest rate, right? Like, I think this chart, I don't know if we're still like on this chart topic or if we've just moved on as far as like, what do we say in social media as far as like definite statements? Yeah, I think you have to be a little careful on like how definite of a statement you're making, but a buyer's going to buy when the time is right for them, right? You're not forcing anybody to make a decision. You're not forcing anybody to buy a house. It's their choice.
Amen, Nicole.
Is it, yeah, are rates a little bit higher? Sure, they're a little bit higher. Were we saying date the rate, marry the house? Yeah, we were. Is that still an okay statement to say? I think agents in general have backed off of that statement, right? But long term, are there still going to be opportunities to refinance at some point? Most likely. So just because we said it, it doesn't mean that we're wrong.
Yeah, no. I'm not.
Remix.
She's like a human beatbox. Jen, we can't hear you at all.
Yeah.
Your audio is completely messed up.
I think that this is just me chiming in briefly, but there is advantage to being a homeowner, regardless of the interest rate.
That, I guess my
right?
concern, so
What I was saying is I think that our
Guys,
job
I'm
is to
sorry to
sell
interrupt.
homes and help people.
I'm
Go
sorry.
ahead, Cass. Go ahead, Cassie.
Can we just mute Jen? I mean, Jen, I'll connect with you after if you can hear us. I don't mean to be rude, but we don't have a good connection with you. So let's mute her for now, unfortunately. And then to Jelena's point, agreed. Like, is it ever really a bad,
Time to buy.
look at charts that were shared a few months ago. I think Colin, you shared them unless I saw them somewhere else, but like since the 60s, except for that one little time in the 2007, 8, 9 crash, home prices have continuously gone up,
Mhm.
you know, since the 60s. So
Exactly.
I agree.
um,
Yeah. Yeah. I think that I just wanted to make sure so everybody understands this is just it's fascinating to me. I mean, when you think about how the government is making decisions about housing, I think this is really really interesting, and a lot of lenders have already put this on their price sheet. If anything, you know, I've talked with a lot of experienced originators that have, you know, they've complained to me, they're like, God, it's already so hard for us to explain how we price a loan.
Yeah.
Right. And this is just a little bit more for me. I will tell you, you know, from my experience, I'm like, hey, you know what? Anything that makes chat GPT LO further off in the distance, I'm all about. Right. I mean, this adds value from an originator's perspective. I mean, I'm sure you guys have a lot of young, hungry loan officers that are saying like, hey, trust me with the deal and things like that. And that's great. And I applaud them. I think that's great chutzpah and sales and all that kind of stuff. You know, but it is getting increasingly more difficult to do our job, which again, I think really adds value if you have experience in the lending space.
Well, and like Rachel has a deal that's falling apart right now because of the lender. So
Raquel,
yeah,
Langeon,
yeah.
what do you mean? The
Hasn't
VA
she-
one?
Yeah, hasn't she talked to you?
When?
Well, I don't know. I'm just looking at what she's posting on social media.
But I think I just want to
Anyway,
chime in
it
real
doesn't
quick
matter.
here and add, Colin, to your point, like lenders not knowing how to do their job and getting this kind of information really just adds to our education of what's happening in the industry. And it gives us talking points in the event these conversations do come up with our clients so that we can kind of guide them forward. But at the end of the day, our goal is always to help people get into a home and see the advantage of home ownership, regardless of what that rate looks like now. One thing I learned early in real estate was I was taught never assume you know someone's financial situation. You don't know what it's going to look like for them in a year or 2 years, or maybe they limit what they tell you about what's affordable to them or what their long-term goals are with home ownership. We don't assume that someone's going to finance a house. We don't assume that someone's going to pay cash for a house. Our job is to go in there and help meet the needs of our clients and help them see the advantage of home ownership and find the right house that works for them. So when it comes to things like this with lending, I don't want to give my clients pointers for what they can or should do in 6 months or a year. We don't know how their circumstances are going to change. I really just try to help answer their questions in the now, inform them of what the benefits are for them to continue moving forward with their home ownership goals now, and then take it from there.
Agree.
Good feedback.
Yeah.
Very, very good. Okay, so we talked about what's changing. If you want to see what lender nerds talk about on social media, they put memes like this up, right? But it really does represent, when we talk about a take home for you guys, FHA is back, and FHA is going to be back in a big way. All right, so now we just talked about this. Borrowers and their mortgage professionals are going to have to weigh whether conventional really is the best option. This used to be super easy. Okay. This used to be, are you above 680? you're going conventional. Are you below 680? You're going FHA. Simple as that, right? Now it's not so clear cut. This is important when we talk about the prospect of loans not being kept forever, right? When I'm talking about this, financing options for people, I'm talking about, okay, how long are you going to keep this loan? It used to be, how long are you going to stay in this house, right? Very few originators have this conversation. I think that's the most important question. Right now, it's how long are you going to keep this loan? Because if you are only going to keep this loan for 18 or 24 months, right, maybe FHA is a good solution for you, because a couple of different things. Number one, well, you got life of loan PMI. Yes, the PMI is cheaper, but I'm paying it for the entire life of the loan. Sure, but you might refinance in 2 or 3 years, right, into a conventional product. You do a single premium, you can do all sorts of things. This loan is a bridge to get your payment cheap right now, which is the most important thing that we're talking about, and to get you into a home that will be a vehicle for appreciation and fill all the other whys out. We're having another child, I'm getting married, we're getting divorced, all these different things that come into life events, right? The other thing I will say, and this kind of ties back to Jen's question about, if you're in an FHA loan, you're in an easier loan to refinance, right? So let's just go down this dark rabbit hole where, okay, home prices stay level, or maybe they drop a little bit, right? Well, gosh, you're not going to be able to refinance because you don't have equity. Not so fast. If you're in an FHA or VA loan, you have a streamlined refinance. There is no appraisal. There is no value collateralization, right? Is your payment getting cheaper? Yep, great. I mean, VA interest rate reduction loans, VA IRRRLs, those are the easiest refinances to do. I posted something in our Ask the Lenders channel maybe 4 months ago where I'm like, hey, when you talk about date the rate and you talk about it with a VA client, it is 100% real, because those loans close in 8 days. As long as there's a benefit to the veteran, you don't have to worry about getting a new VA appraisal. There isn't one in a refinance. So these government loans are a lot easier to refinance than their conventional counterparts, right? And that does become key if we don't see price appreciation. Danielle, you asked a question about social credit score implications on central bank digital currency. I know that you know a lot about this. You probably know more than I do with the Fed and this digital currency thing. I don't know a lot about that. But that is on my list of things to read up on.
Thank you.
So you look at PMI comparison, right? Well, it used to be 85. When I talk about, look at this PMI chart, and I know this is a little bit, hard to understand, but the PMI on conventional loans, even at a 700 credit score or a 680 credit score, FHA starts to become more appealing than a conventional loan. And I'll give you a real life example, okay? Let's say you have a conventional loan, 3% down. Chelsea Wood and I just had a client that was doing this, right? They were over the income limit, so they couldn't use Home Possible, Home Ready. And the rate difference between conventional and FHA was a full percentage point. The MI was a wash, right? $210 for conventional, $212 for FHA. So for a $400,000 purchase price, minimum down payment, 700 FICO, the payment was $265 cheaper FHA, right? Now, that said, we all know about FHA appraisals and things like that, but I think this is good, especially for you listing agents out there, right? I mean, you remember in 2021 where it's like, where the hell are all these cash offers coming from? It was because Cash Compete came in and it's like, hey, look, Knock and other similar programs like Home Point has Cash Compete program, like pay cash for it and then, do a standard refi after the fact. It'll help you compete because you're cash, right? I think you're going to see a lot of listing agents that are like, where are all these FHA offers coming from? right? Especially because FHA has not been really, I mean, talked about a whole lot in 2020 and 2021. Like you're either going to be conventional or cash. So I think you're going to see FHA come into the fold a lot more, especially when people are payment sensitive. First time buyers, right? That are
Colin.
straddling that credit score. Yes, Nicole.
How much of the payment difference is because of the extra half a percent down?
Very little.
Okay.
Like
what purchase price was this? Oh, 400. Sorry.
Yep. Yeah. So, I mean, you're talking about 200 and that's $2,000, right? So, I mean,
Okay.
yeah. So 10
Yeah,
bucks of
so
it.
not
I mean,
not super significant.
it's really just the difference in interest rate. I mean, this would be no difference if we talked about rates at the beginning of February and the end of February, right? Rate at 7% versus rate at 6%.
So
And remember, and some of you
likelihood
may
that
not know
they
this, like FHA rates are cheaper than conventional. Sometimes they're a little bit cheaper. Sometimes they're a lot cheaper. Depends on what's moving in the market. But don't be afraid of FHA. Especially if you have a really clean house. You know, we talk about appraisal issues and things like that. A lot of really old school lenders have ideas like, Nicole, how much easier have FHA appraisals been since you started in the business? Have you seen them get easier?
A lot easier. I mean, currently I do way more VA than FHA, right? And VA appraisals have gotten a lot easier. So if VA is easier, then FHA is going to be just as easy.
There used to be things with like ceiling height, like crazy stuff that
Yeah.
HUD had a guideline on. And as we've gotten further away from 2008, the standards and the work orders for FHA loans have become a lot softer. Now, some agents, especially if they only do 5 deals a year, and they had one nightmare FHA deal in 2016 where they had to go out and, you know, scrape peeling paint. It was the worst experience of their life. Like, okay, number one, you probably don't do a lot of business. Number
Right.
two, that was 7 years ago. So, you know, do you
Well,
want to consider our offer or not?
I have personally gone out and scraped peeling paint.
No doubt.
So,
Yeah. Yeah.
yeah.
And cleaned it up. That's the key thing, you know?
And repainted.
Nicole, you say you do a lot of VA, so I'm going to end on this slide. VA also cut their funding fees. Who could tell me what a funding fee is?
The amount that the veteran pays that gets added to the loan amount if it's not forgiven based on their disability.
Nailed it. Exactly.
Okay.
So just like FHA has 1.75% upfront that gets rolled into the loan, VA has no monthly PMI, but they charge veterans this percentage of the loan amount upfront. It can be paid in cash 99% of the time. It's also rolled into the new loan. Okay. So if you think about this applied to a $400,000 home, you would have 2.15% of the loan amount that is added on. So you have a 0% down payment, you have a $400,000 loan. Your loan is actually about $408,000 and change. Okay, because you've rolled in that upfront funding fee. These funding fees are getting cheaper. They're not getting cheaper by a whole lot, but it is something, right? You talk about a savings on a $400,000 loan for a 0% down second user of the VA home loan. You can use the VA home loan benefit as many times as you want. I mean, it's $1,200. You know, that's something. So, overall, what I would say is these are really good measures by HUD to make, you know, we'll take all the good news in housing we can get right now. So, I mean, these are really positive things in terms of affordability, both with FHA cutting their MIP and with VA cutting their funding fees. Questions about anything we covered here today?
I've got a trivia question for $5 gift card.
Oh, sounds like Holly's been
The
talking to you
Starbucks
a lot.
or
The
something. What's that?
Starbucks. That sounds like a Holly plant.
I just, we're talking about funding fees, the 1.75 FHA and then change the VA. Who can tell me what the USDA upfront percentage cost is?
Oh.
I don't know about percentage, but I think it's $6,000.
What did Nicole say?
0.
Not yet. Nobody has it yet.
It's
not
1.5% of the loan because I have a USDA on my house.
It is not 1.5%
That's what I pay on my home.
for an upfront mortgage, the upfront fee.
My
do
upfront fee was
0.5%.
$6,000.
It's not, what'd you say, Nicole?
0.5%.
Nope.
You guys are so
1%.
close.
Yeah, Nicole, 1%.
Okay, like, let's just keep guessing.
It's 1% of the loan amount.
Colin, I
So
have
I
a
don't know
question.
who, Jelena, they might, might want to find what they did with that extra 0.5%.
Yes, who said they had a question? I'm sorry.
Chelsea did.
Yeah.
Why when a buyer takes out a VA loan, why is it that the second use, third use, fourth use of it, they're essentially penalized for using it more than once?
I wouldn't say that they're penalized because if you look at the 5% down row here, Chelsea, it's exactly the same first or second use. I think what HUD's trying to avoid is, hey, if you used a VA home loan and bought a home and now you're selling that home, like we'd like for you to put 5% down on your next home.
But I guess you don't, so like, that's like them saying, since we know you're probably not going to, you'll probably take your VA loan and use it a second time, put 0% down, we're just gonna charge you this instead.
Correct. They're incentivizing people to say, hey, you've used this before, home prices have gone up, you have equity in your home. If you're a responsible borrower, we encourage you to take some of that equity from your home and put it toward a down payment. So it's not that they don't like to see 0% down. They don't like to see 0% down multiple times. And that's where this funding fee difference comes into play.
Okay, thank you.
So
Let's
is this-
remember too that the VA is lower interest rate, comparative to FHA, and there's also no mortgage insurance on VA loans. So that's another added benefit that is not usually seen.
Mhm.
So Colin, this chart is showing that if you have 5% down or more on a subsequent use, the funding fee is 1.65 currently, and after April 1st is 1.5.
April 7th, but yes.
Yeah, sorry. Yeah, 7.
Correct.
One more question with this too, like how FHA's funding fees have gone down. And you said that Flex was honoring them. Are you guys honoring VA funding fees ahead of time too?
I know that, so FHA, the monthly mortgage insurance, that change is effective immediately. You close a loan with us tomorrow, you're going to get the new PMI. Okay.
Correct.
Matt,
Does
the
that stand for the
VA,
VA? Or is this with just the government? So like you have no say in it?
no. So what happens is that like lenders will move either slowly or quickly. And that's actually an excellent question because, if you have a smaller lender or you have somebody that may not be working with a really big mortgage partner, they're not going to move quickly on this, right? So you might have closings, forget about the VA part of it for a second, Chelsea, but this is supposed to take effect on March 20th, right? Did I put that in here? This is supposed to take effect on March 20th, the change from 85 to 55. And if the lender is not honoring that, I think they should. Like all the big ones have moved into line and said like, yeah, no problem. If you close between now and March 20th, you're going to get the new mortgage insurance. I would assume that VA is exactly the same. Matt, I haven't heard specific direction about VA funding fees being cheaper.
Oh, yeah, he's talking about when they're gonna take effect.
Yeah, like for example, like Nicole, you and I have a VA deal that's closing at the end of the month. We're anticipating that he'll be exempt from the funding fee. But if he were not, there'd be a big change between 360 and 330.
Yeah,
So
I mean,
Chel-
I was just thinking about that. Like if he ends up not being exempt, he'll have 5% down. He should do that.
Yeah,
It is April 7th, Colin. I'm saying it's gonna be April 7th closing.
who's saying that?
VAB.
Wikipedia?
Yeah.
Yeah. So that's something to keep in mind. I mean, that surprises me. I think we're going to move very swiftly to see this enacted immediately. I know FHA's already done that, but Chelsea, I don't know if this is going to happen April 7th. VA will also credit you back in some cases. So VA will go retroactive on that. That's a really good question. All right, anybody else on this stuff?
Just curious about this, but doesn't that almost incentivize some people to go FHA instead of conventional on their loans now?
100%.
It's cheaper PMI, a cheaper rate.
100%.
So it's how
Yeah.
to communicate that in the market to listing agents and sellers that there's a financial advantage to borrowers using this program now instead of versus just conventional.
Yeah. And how would you do that?
Educate.
I would tell them to call the lender.
Sure. Yeah, for sure. Yeah. FHA cut their mortgage insurance. We're seeing a lot more FHA pre-approvals right now. And it's been great. And if you have more questions, call who's on the pre-approval letter, if you can get them to answer.
Thanks, Colin.
Thanks, everybody. Appreciate it. It's good to be with you today. March is going to be better than February, I hope. Palmer, come here.
Big P.
She's cute. Who is that little girl?
This is Palmer.
Hi, Palmer.
They want to talk to you. They want to talk to
How
you.
old are you?
How old are you? Yeah.
Hi. Do you have a wiffle
ball.
ball?
Yeah.
Just don't throw that at daddy's head, okay?
Oh,
Maybe do it.
oh yeah. I love you.
Throwing it at your brother's okay, though. Oh, I shouldn't have said that. I'm sorry.
Oh. Thanks, everybody. Jennifer, good to meet you.
Bye, Colin. Thank you.
Bye.
Have a great day.
Thank you, guys. You too.
Nice to meet you. Thank you so much.